This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview.
Is Kiran Morzaria, the CEO of Cadence Minerals, following an update from the Amapa Iron Ore project. Thank you very much for joining us, Kiran. Again, how are you?
Good, Mark. Yes, and how are you?
Very good, thank you. It's good to be catching up. Quite a comprehensive update there. I want to go through some of the elements there. The first thing is the optimization studies that are underway to reduce capital expenditure at the plant. So that's ongoing at the moment. How are things looking on that front?
Yep, that's looking positive. I think we said last year after we'd completed after the PFS was released, we wanted to do some optimization studies, and that had started during the tail end of last year. And the optimization studies were really two things. They were basically trying to reduce the capex of the plant. And so far, from what we see, that looks really positive. And I think I feel very confident we'll be able to reduce the capex on the plant.
Okay.
And so once that comes out within the next quarter, we'll update the market, and we'll see what happens. But I think it's positive that we've done the work, and now we're finding that there are some capex savings and that you've got to think about is in an environment that has been an inflationary environment inflationary mining environment over the last year or so.
Indeed, no, it's good to be finding those cost savings. I noticed as well you were losing the Aquis listing as well to again reduce some of the corporate costs there. So that's of course always a prudent thing to do. Something else that caught my eye was on the processing flow sheet. You've got a new process flow sheet where you've been able to actually increase the product quality to 67% iron concentrate, which I think is up from 63 or something on the last one. So that's pretty good. How have you been able to do that?
Well, in essence, they used to produce a 65.6 or 66% material by running the material that effectively after it gone through crushing and grinding and sort of benefication, running it through a reverse flotation cell, which it's a process where you float off you float off all the waste and the iron goes to the bottom. Okay. And they ran it twice through to get this high concentration, but they reduced the amount they were producing. So what we have done is through some extra grinding, through some extra magnetic separators, have been able to, on a preliminary, let's call it what we feel the preliminary basis, we believe that we can increase it to 67%.
Okay.
And what that will mean is that we'll be able to have 67% only instead of this mix of 65 and 62. So that means we'll have a very high quality product. Possibly some people would call it green iron because it could go into a DRI furnace. And obviously that means it could also go to places like the US, which would reduce our shipping costs.
Okay.
But producing that 67% is actually, if we're able to do that, would be a really important upgrade, and I think will have a significant impact on the NPV of the project. So what we're doing now is we've got to collect 2 tons of samples, representative samples over the life of mine, send that to PSCI in China, who will then do the full mineralogical analysis, flow sheet analysis, and actually run it through effectively a batch flow sheet process to see that are we able to recover that 67%, and what are going to be the impacts on things like water, tailings, extra, what is a mass recovery? So these sort of things. So what I expect to certainly be able to do is, in all probability, is be able to put once we have the initial report, put together effectively a scoping study level view on that 67% and the impact on the NPV. Then it will go to effectively a PFS level by sending those samples. So we've got a couple of stages to do there, but it's actually, the engineers feel very confident that they're going to be able to achieve this. So hence it's in the announcement.
Well, that's good to see. So we can expect that report and then feeding into a new scoping study to see how that affects the MPV there. You say it's relatively simple. Is it using like magnetic separation? So it's not going to be a huge challenge to install the new process?
No, it's obviously we're going to be utilising incumbent machinery that we have because we don't want to replace effectively all the machinery. So it is going to be some extra mag seps and mag separations and a finer grind. And that will mean that we're able to liberate more of the iron and recover more of the iron as a result of that. That's what they're saying, and that's what they've seen and done beforehand in these type of deposits. So that's what we'll be doing. In essence, if we, preliminarily, we see that the capex of this new higher grade product, which is going to generate higher revenues, larger margins, etc., will have the same capex or roughly the same capex as our original PFS. So we were doing it's going to be about 200 million installed costs for the plant. We expect it to be roughly the same for the 67% concentrate. For the 65, 62, which is the lower cost, we expect lower cost than that 200 million. So it's sort of looking at both of these options. We're firstly going to, publish that 62, 65 PFS level capital expenditure reduction, which we anticipate to do, as I said, in the next quarter. That will have obviously an impact on the MPV. I don't see it will be material, but it's not going to be as large if we do the 67. So if we do the 67 and it's successful, that will be our base case PFS going forward.
Okay.
So we're doing these two things just in case the 67 isn't successful. We still have a lower capex on the 65, 62%.
Sure. Okay. And you mentioned earlier there about being able to potentially ship direct to the United States. Is that because how does that comment fit in with the 67%?
Well, I think the United States is much much more attuned to getting high grade material, and instead of utilizing metallurgical coal to burn 62 and 65%, adding the limestone and producing iron effectively, and then eventually steel. If you send it to the United States, they're much more receptive to getting high grade and then utilizing either DRI or so electric arc furnaces, or possibly even hydrogen furnaces. So it becomes a green steel. And so, that is much more suitable in the United States. There are plans afoot that may happen. And so by shipping to the United States, of course, it's much, we're in the north of Brazil. Instead of shipping all the way to China, it's going to make a considerable cost. Could make a considerable cost saving. So if you think about our current cost basis, FOB or our CFR, which is our cost to China, is in the $60 mark. Well, to the US, that could come down to $45 mark or $50 mark, depending on shipping rates.
Okay, good. Thank you, Kiran. I want to just catch up a little bit, if we can, on the development of course, the whole project here on site here. I know you're waiting for environmental licensing, but you have that on schedule, and you're expecting the installation licenses to be granted during this year. So where is the company at in terms of moving down that route to being able to start construction again and rehabilitating the mine?
So in terms of the licensing, there are two sets of licensing that we're going for. So there's sort of two batches. So they're both installation licenses, which in Brazil, you get the installation license, which is an environmental installation license, so you're allowed to rebuild it. And then at the end of the installation license, you get your effectively operational license. So we've got two tranches. Our tranches for the mine, the rail, and the plant, which we have submitted the plan to the environmental agency. So all the field work for that has been complete. And then we're waiting for the environmental agency to come back or have any questions. So that will be one of the first licenses to be granted, an installation license. The port, we're having to do an additional ground survey, or effectively environmental monitoring, which we expected, and that's part of the timeline. So we'll only submit that report in probably somewhere between June and September. And once that's gone, it will take about 3 months for them to complete that. So that's why we say, all of the licenses will be awarded. We expect them in 2024. Certainly, we would have submitted, and we are on target to submit all our requirements in the timeline for that to be achieved. Of course, construction and rehabilitation is obviously dependent on both project debt financing and project equity financing. And obviously, the debt financing, we made progress, and we're making progress with the equity financing.
Well, let's talk a little bit about the financing here. You've got debt and equity. I understand I think when we spoke last time, the DFS is funded, but then you would have to seek the financing to construct the mine. Is that right?
So what we've done, and with this discussions with any potential equity and debt finances, is discussing the requirement for a DFS. So at the moment, the view is that the DFS will get rolled into the implementation phase. So that gets rolled into the construction. So actually what we don't need to do right at this point in time, bearing in mind our conversation with the partners, is that we don't intend to embark on a DFS, and we'll go from pre-feasibility study, and the detailed engineering and implementation phase work will get done after we have the installation licenses with our debt financing partners. So that it becomes part and parcel of the construction process, put it that way. That does carry probably some additional risk because you haven't done the DFS, but it also shortens timelines. And also, importantly, we don't have to fund it.
Right, okay, yes. And how are the sort of discussions going on different financing routes? Are you at that point yet?
So the MOU we announced with Tangent Cement and Design Research Institute. So that is progressing. So the MOU is there. The discussions around the DFS we've had with them, and we're now really sort of the main item that we need to secure from in relation to that debt funding is what they call corporate guarantees. So we need, both our joint venture companies are relatively small companies, so we need to get a corporate guarantee on the debt. But again, we're working at that process, and I feel confident that we'll be able to achieve that eventually. Okay. The next part of it is the equity financing, because you need to finance, the debt can be between 70 and 80%. Indications from TCDIR is it's going to be 80% debt. And what we would expect now is we have to secure the equity, which is going to be 20%. So we are in discussions with and received several expressions of interest with parties for that equity funding, but that would be at the project level, so not at or at the JV level, so not at Cadence and or Indocina level, our JV partner, but it would be at the project level that equity would go, and they would become equity partners in the project. So that's everyone from some strategic strategic investors, both in private equity and also in other parties such as potential miners that have been in those discussions. But it's early stage at the moment. There's still a road to achieve. But as I said, what we want to try and achieve that this year, if at all possible.
Well, that would be certainly a big milestone, wouldn't it, if you could achieve that this year? And you mentioned earlier you would want to get into construction after PFS, so a little bit earlier than planned, you're almost going a bit down a fast-track route, is it fair to say?
Get into construction after the installation licenses have been completed. The PFS is done. We're updating the PFS for these lower capex and higher product quality, which is increased margins, better NPVs, better internal rates of return. But especially if you've got a brownfield site as well, you would also have a less engineering risk as well, because it's not a complete greenfield site. The process is known. The railway is known. The difficult engineering is there isn't really much of it apart from some of the processing route in relation to this. So that's why these discussions have gone through, that we don't really need to embark on a DFS as part of this process. As part of this process,
but you would still look to do one in due course.
It would get incorporated into the implementation phase. Yes, it just gets rolled in. So what we go from a PFS to DFS, you're improving the engineering aspects. You're saying, right, well, I'm going to lock down, and that becomes a 10 to 15% accuracy, lower contingencies, etc. On a implementation phase, it's effectively you've got 90% of the stuff engineered and designed. So what you do is you just go from PFS and go to the implementation phase. That, as I said, has some engineering risks along the way because, for example, you might not have done some calculations correct, and actually that might add a bit more time on the implementation phase. But overall, given that it's a brownfield site and our discussion with potential financing partners, their feeling was that actually let's just roll the DFS into the implementation.
Okay, good. Well, that's very good. It could be a nice little thing to happen this year then. Let's just finish off quickly, if we can, Kiran, on a couple of other elements from that update there. You divested your interest in Hastings Technology Metals there and reinvested that in the proceeds to the Amapa project here. You got about a 30% return. I know when we've spoken about this side of the business before, that's not probably where you want to be, really, is it? But did you just feel it was prudent to take that 30% and put it to Amapa?
Yeah, I think, yes, it's not the return that we want. We're disappointed with that return. However, we felt that given the pricing of and basically the neodymium and praseodymium baskets that are out there, we felt that looking at timelines of change in that price point and looking at the requirement for capital into Amapa and the potential return there, we thought it would be better to get a return, albeit not as high as our expected typical returns, and reinvest that in Amapa, which we certainly believe has a much more high likelihood of a much better return and a quicker timeline to it.
Okay, good. And you're also exploring the additional iron ore material resources adjacent to the Tucano gold mine. I think, was it targeting 500 million tons here? I mean, this is sort of new news. Where's this come from?
Well, so we already, in essence, what has happened is there is already 143 million tons of a historic resource on the Tucano joint venture area, which is just to the north of us or northeast, and that's a gold mine, and we have the right to iron ore on that area, and they have the right to the gold on our area. So it's a reciprocal agreement. But they also have other exploration areas, and we were reviewing these in more detail and looking at the historic data. And across around 4 areas, there is a mineral potential of about 500 million tons, roughly. So that's not a resource or a reserve, but it definitely shows that with our asset and with our joint ventures that we have access and could put our foot on to if it was all to be successful, in excess of 700 million tons or 800 million tons of iron ore. Now, these assets are a bit more disparate, but they're along the railway, which we obviously have our concession for. So again, when I really illustrate the importance of having a concession for that railway for 26 years or thereabouts and owning the port, you have ownership of that railway and infrastructure. And in iron ore, that railway and infrastructure is one of the most important things in your cost. So, because it's a bulk material. So having that and having these potential targets close by means that in the future, and for any potential JV partner or project financing partner, they can see that ultimately there's more potential for expansion of the iron ore and utilizing the current infrastructure to develop those. So I think for us, what we will be doing is looking at getting that data from the 143 million tons, seeing if it's valid, seeing how much is there because it may have been depleted. And we will then decide whether we need to go down a drilling program to define that up as resources, or we'll just leave it as is and utilize that as part of the upside. And in terms of the 500 million tons, this is stuff that was done by Anglo. It was a mineral potential from Anglo American. They looked at those and identified those 500 million tons. Again, we might do some early exploration. All depends on capital and equity availability to do that work. But it shows what we're trying to show here. It's not just a story about the 276 million tons, 16-year mine life. It is about a much larger play in which we have, as the PBA has the ownership of all the infrastructure required to develop that, and we have JVs to develop it. So it is really a much larger play than just the Amapa asset on its own.
Okay. Well, thank you very much for your time today. Kiran Morzaria, the CEO of Cadence Minerals. I look forward to following developments in what hopefully, I'm guessing, could be quite a significant year for Cadence.
Yeah, that's what we're working towards.
Thank you, Kiran.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.